Lewis holds 40 to 50 stocks. The key to that is they limit the number of stocks to 50, and this is something we're going to be watching going forward. Whenever they want to put another stock into the portfolio, one of their current stocks has to be eliminated from the portfolio going forward.
And we kind of thought that was an interesting concept.
Because what that does, they're not limited to saying, well, I think this stock still has a little more to run, we're going to hold on to it. They won't fall in love with the stock. They've got to get rid of one to put a new idea in the portfolio. So it really is a good risk factor for them, a risk management tool for them to use. And speaking of that, they also have their separate risk management team. They have the portfolio managers who run the portfolio, and a separate team who looks at the portfolio from different risk factors and tells the portfolio managers, okay, we're taking too much risk in this sector, we need to mitigate that somewhere else. They limit their sector weightings to plus or minus 10% of the portfolio, so we're not going to see the large cap growth manager get really heavy into one sector, such as technology, like we saw in the late 90s, then have technology fall off the face of the earth. They're going to be limited to plus or minus 10% on that sector. We're not going to see them get hurt too badly. And their initial purchases are limited to 1 to 3% of the portfolio. If they have an idea, they're not going to jump in and say, we're going to put 10% of the money into this idea. They're going to buy into that position slowly to see how it does. After looking at the numbers and watching the presentations, our final recommendation here was Gardner Lewis Asset Management for the large cap growth portion. The next asset class...
Just kind of real quickly, again, I kind of touch on, we described the alpha, but that up market, that down market statistic is a good one because you could conceivably have a manager that does great in up markets, but you're also measuring, when the market goes down, how they do.
Are they more adversely impacted than the market?
And that goes really to looking at their risk factors. Are they going to put a lot in a certain sector that could really go bad for them? On the small cap side, we had two managers, Battery March and Iron Bridge. Battery March out of Baltimore, Iron Bridge out of Chicago. As you can see with the highlighted squares, Iron Bridge pretty much had the advantage everywhere except in down markets. Down markets, they were still above the median, and when we look at the universe, they were in the top 40% of all managers. Battery March,
Thank you.
Did very well in the down markets, but you can see in the up markets, they really give up a lot, up only 48% in those markets versus 64% for Iron Bridge. These numbers, by the way, are all on a 4-year basis. Iron Bridge is just approaching their 5-year anniversary. They're looking to close fairly soon. We don't want to penalize them for only not having 5 years, so we looked at 4-year numbers across the board. Page 11 with the growth of $10 million. You can see Iron Bridge, again, trailing back in the 1999 and 2000 when the up markets were really going. Battery March was able to pull ahead there. Once the down market happened, we saw Iron Bridge start to really take off, really especially since in the past trailing 1 year. Battery March was really hurt by the high quality stocks. Iron Bridge was able to really take advantage of that market and outperform on a dollar basis by about $1.5 million over that time period. The presentations and their processes were considerably different. Battery March, purely quantitative shop. Similar to C.S. McKee, where C.S. McKee will use the black box to get the stocks, then look at them at least. Battery March uses the black box and just goes forward with them. They only look at high quality stocks, and that can hurt them in certain markets, such as we're in right now. Iron Bridge had probably the most unique process we looked at over the 2 days. They look at not only sectors, but also where stocks, companies are in the life cycle, whether they're emerging, whether they're at maturity, or whether on the downside. And they'll pick a portfolio and put it together across the entire life cycle. And they'll diversify across the entire life cycle. So you'll have some aggressive growth companies, as well as maybe some distressed companies who are looking for a catalyst to improve the stock price. One comment I had about Iron Bridge is you always want to hire the smartest guy in the room. The guy who came from Iron Bridge, I thought over the 2 days was probably the smartest guy who's been in the room for quite some time. Very smart people. They're looking to close the portfolio to new business coming up probably within the next year. I think now's a good time to get in with them. Our recommendation here would be Iron Bridge. Finally, on fixed income, we have two different managers coming, Great Lakes and PIMCO. Two very different companies and portfolios were presented. Great Lakes, a smaller company out of Chicago. PIMCO, the giant in fixed income, over $350 billion managed in total. Great Lakes runs a very conservative, vanilla portfolio. PIMCO will spice up the portfolio with some emerging markets, some high yield bonds, some international bonds. When we look at the performance, it's fairly even across the board. 5-year return, PIMCO slightly ahead. 3-year return, Great Lakes slightly ahead. We're talking basis points here. Alpha, PIMCO has the advantage there as well as in the up markets. What's interesting for both managers, if you look at the down markets, again, these are markets, quarters where the Lehman Brothers Government Credit Index was negative. Both managers were positive in all of these quarters. As far as fees, Great Lakes has the fee of PIMCO just about cut in half, 24 basis points versus 45. Looking at the growth of 10 million on page 15, very similar with PIMCO jumping up ahead back in 2001 and early 2002, and again slightly in late 2002, early 2003. Reason for that, they opportunistically will invest in that international in high yield, which has done very well over the past year, and that's given them a little extra pop over the near term. The presentations, pretty much as I described, you have vanilla versus core plus, they call it, small versus large. When it was all said and done, we decided to make the recommendations Great Lake Advisor, the smaller firm with the more vanilla portfolio. Going from an index fund to something as diversified as PIMCO, we thought might have been a big leap to take. Also, there would be the questions when people would look at the PIMCO portfolio, why are we invested in Spanish securities? Why are we invested possibly in emerging markets in Singapore in the fixed income portion of the portfolio? We thought Great Lakes was a little more conservative. They're all high quality bonds, BBB or above. They keep the interest rate, the duration, fairly constrained. We felt more comfortable with Great Lakes. In addition, with some of the ideas that Jack and I have talked about, we feel working with Great Lakes down the road, they'd be more in tune to work with this on some of those different projects.